Hi, Christina. So we talked about last time about differential analysis and looking at third party scenarios. And this week, our topics are looking at inventory and also looking at break even analysis and budgeting. In addition, I provided an additional older lecture of mine that I give to my entrepreneurs reviewing about ways we get paid. And these are all very important aspects as a pharmacy manager. But in this short lecture, we're going to talk about inventory management, which you can refer to some of the things I referenced from chapter 24 in the pharmacy management book. And we'll discuss this during our live discussion. And the same with budgeting and break even analysis. Because no matter what, in a community pharmacy in 2021, and for the last, you know, 50 odd years and probably maybe more, the two most expensive things to run a pharmacy and to show profitability of a pharmacy is the controlling of salaries and inventory. Those are the two most expensive things. And so let's take a look here. Okay. So the biggest thing, if you think about, we're going to talk about cash flow in a couple weeks, is the cash conversion cycle. The flow of cash is vital to all companies, regardless if it's pharmacy or others. And the goal is to maximize, the inflow of sales while, minimizing the outflow of overall costs. And obviously, having good operational efficiency is the key to profitability. And as you did your strategic plan of your immunization program, and as you're going to look at your financial projections, one of the key aspects we'll have to look at is real-time inventory with vaccines, because vaccines, just like prescription drugs, can be short dated. And also sometimes vaccines have to be bought in bulk versus individual. So obviously this cash conversion cycle plays a big role. The other key thing that we need to recognize that inventory, when it's included on the balance sheet, it's a current asset. All right. And that's because it's not a fixed asset, but it can be turned to cash quickly. However, it doesn't have any value of turning into cash until it's dispensed and billed and paid for. And when we bill it that day, even though we registered as a sale, we are not going to get paid probably anywhere from 3 to 4 weeks. And so this turns into accounts receivable. Now, accounts receivable is more liquid than inventory because we already got a promise somebody's going to pay it, but we have to be on top of that accounts receivable because that can play into our cash conversion cycle. And that is why this continuous cycle of how many days something is in inventory to how many days we're getting paid, because the day I dispense something, a lot of times I may have to replenish it. And that is why it's so important. And we're going to talk about in the next couple of slides is reorder points and maximizing efficiency of our inventory. The good thing in 2021 is the ability to get drugs next day from most wholesalers is capable, and so that we don't have to carry as much on our shelves. But another thing is we can lose sales and we can lose customer loyalty if we don't have product to deliver, because as we know, medications a lot of times need to be started now rather than later. Another thing is I pointed out, though, even though inventory turns into accounts receivable, it's so important that every pharmacy has a department, all right, or has a key person is making reconciliation is occurring. Because when we build out to the pharmacy benefit manager, and they come back and say, this is what they're going to pay us, we need to make sure that our inflow and outflow, all right, are matching. The cash needs of a company resulting from the difference between these two processes, can be vital in being able to fund. And, for us to be able to additionally borrow for the company to stay profitable, this cash conversion cycle is a must. The other thing too is our ability to get paid is going to reflect our ability to pay our vendors. And if we can't pay our vendors, obviously they can refuse to offer future or any types of discounts. If we get into such a bad point that there are times you'll read case histories, not just independent pharmacists, but chain pharmacies where they became so bad in their cash flow and their ability to pay that they do not get drugs unless they pay upon delivery. The other thing too is it can affect our gross margin if we're not maximizing the discounts that maybe the vendors, the manufacturers, or the wholesalers are willing to do. And that's why having a good accounts receivable department, staying on top of are we getting paid, is so important in addition to inventory. So we first think of actual purchase as the cost of inventory and what we bought it for. But there are some other basic costs when we're looking at the overall cost of inventory. That includes the process of ordering it, which has become a lot easier now because we can do real time ordering. Our pharmacy systems have the ability to order directly online through the internet. The ability to carry inventory, whether it's managing on our shelves or managing in another warehouse, that the time it sits on the shelf is the time that it's just sitting there, not converting to cash. There's also a cost to stock out costs. Sometimes if we run our inventory too tight and every day all we're doing is besides filling regular prescriptions, filling O's to people, there's an additional labor cost for that. And there's also the additional potential loss of sale because not meeting that. And so purchasing costs are the most easily identifiable cost, exactly what you paid for it. But there are different additional inventory costs we need to take account for. As I mentioned before, sometimes our vendors, our wholesalers are willing to offer discounts on prompt payment, and these are a way to entice customers to pay on time so that they maintain their own cash conversion cycle at the wholesaler level or the manufacturer level. So, for example, 2% net 10 means that 2% cash discount of the total invoice may be taken and the entire balance is paid within 10 days, within less than 10 days, I mean, instead of the traditional 10 days. Given the time of value of money, sales discounts usually provides a large annual rate of return and should be taken by companies even if the short-term borrowing is required. And so what does that mean? Sometimes if there is a product that we sell a lot of, so for example, cephalexin, all right, antibiotic, and you can get an additional 2% off of that if we pay within 10 days, that it may be worth our while to go out and borrow money or maybe take some money out of our, you know, assets, all right, to be able to purchase that. Sometimes too, although we don't always know when price increases are going to occur, if you follow the trend, most brand manufacturers raise the price in January and July, and then sporadically throughout the quarters. And so you have a potential to buy additional product before the price goes up, and you can borrow short-term borrowing from that. Then when you go to bill that with the price increase, there's a place to have an additional gross margin. So sometimes these are additional advantages and being able to manage your inventory and the ability as we talk about cash flow in the coming weeks, that can play a big vital role in the profitability of a company. Another thing that happens, especially in the long-term care arena, the closed door pharmacy arena, is contract bidding and buying groups. And sometimes there is special pricing in that. These programs can be significant benefit for smaller pharmacy operations because they permit them to take advantage of volume purchasing through a large buying group or wholesaler. So we currently, my company that I deal with, deal with a wholesaler that belongs to OptiSource, which is a larger consortium that buys generics from the various different manufacturers. And the more generics that all our members buy from our wholesaler, the more profitable OptiSource is, and the more discount and rebates returns we may get. And hence, that's one of the key ways that independent pharmacy has been able to stay in business. When you go into the closed door pharmacy arena, long-term care arena, and we talked a little bit about this in our live lecture a couple weeks ago, there are different buying groups: MHA, Innovatics, GeriMed, and these groups offer the ability to buy product at a negotiable price, especially if we meet certain volume measures. And so sometimes in this competitive bidding or bundling, the purchase of one product with the amount of additional products. All right. So if we meet a certain market share within, say, that we buy back when, let's look at the urinary continence inhibitors, not inhibitors, the medication used for urge incontinence, like Vesicare, Detrol A. Back when they were brand, if there was a certain brand out of that market share willing to offer the discount, and most formularies covered that, if we were able to maximize our purchases for that out of that market share, we may get additional revenue. And back in the day, when and still occurs in skilled nursing homes that take Medicare Part A patients. And when they take Medicare Part A patients, they are responsible for the cost of those medications while they're Medicare Part A. And those are people coming from hospitals due to rehab, post-stroke, that fall under that 100 days of Medicare Part A coverage for all Medicare beneficiaries, that they're responsible for the drugs. And so a lot of times long-term care companies like Omnicare will develop formularies for these skilled nursing facilities. But the way they can find a win-win with this is sometimes with this competitive bidding purchasing of different products. And these are very important because they help make decisions on purchasing and market share. As I said before, there's additional other costs to consider besides the product itself. There is the ordering costs associated with placing an order and processing the corresponding payment. So, for example, even though we can order in real time, it might be more beneficial for a pharmacy to purchase, say, like C2s, maybe only once or twice a week, because there's more steps in that process, the more recording of it. And so maybe there's a way to control those ordering costs. And that ordering cost mainly is the cost of time for the pharmacist or the technician to put that order together. There also can be, depending upon the different vendors, where there's shipping cost that comes into play if they don't meet a certain minimum. And so those costs have to be associated when we're purchasing. Even though we can get a great price on a certain product from, a smaller vendor, who's looking to have a product that may have short dating, maybe it goes out of date in 6 to 10 months, but it's a popular drug and it's a good price. That there may be that offsetting, that if we don't have other products to purchase, it may be more costly than purchasing itself. So any costs associated with receiving the goods and getting them to the shelves for dispensing should also be included sometimes when we're looking at basic inventory costs. Most pharmacies, as I said before, place daily orders with their wholesalers, and payment is paid through the accounting department. Putting an order on the shelf is also considered part of the routine daily duties of a pharmacy staff. Although, if significant, these costs could also be identified separately. So I'll give you an example. Two of our pharmacies, we have a Script Pro, and that Script Pro is beneficial because it can fill, anywhere from our top 200 to 300 medications. However, when we looked at certain generics that we purchase, we were able to do two things. We looked at whether or not we could double up the sales of that popular generic so we don't have to refill it as often. And that also allows us only have to order it not as often. And so this might be a way to control the cost that it takes to stop, shut down the robot while we replenish inventory. Bulk purchases that need additional outlays, such as an offsite storage and labor to unload and distribute its cost, should be added to the overall purchase when placing orders. So at one time, when we handled our flu vaccines, we used to order it from one pharmacy and we would distribute to the other pharmacies. And we found that that cost was too belaboring. And so now we kind of take the estimates of which each pharmacy uses per year, and the flu shots are ordered through directly through that pharmacy and shipped right to that pharmacy. So basic inventory costs, such as putting the order on the shelves, also need to be taken into consideration. Also, not all items in the inventory generate the same level of profit. As we know, and I talked about if you watch the video in terms of payment for products, is generic medications usually provide a better, margin than compared to a brand. And so sometimes it is okay to have a bottle of 1,000 of a hydrochlorothiazide on the shelf, whereas having, bottles of high expensive brands can be expensive. I actually have one pharmacy owner that I talked to, and actually I've tried this out in my family's pharmacy, where we actually have all our brand products in one bay by themselves. They're not even in alphabetical with the generics. And we do that for two reasons. One, it's a better way to start looking at our inventory to make sure we don't have too much on the shelf and kind of have that physical eye, even though we're running it out of the reports. But those are things that, because profitability is a very narrow margin with those, keeping too much on hand can be costly, but we don't want to be out of product. Some items require more inventory space than others, larger bulk items. We also have our refrigerator items, our costly, insulins. Think about what's in your refrigerator. That's probably 20% of all your inventory costs, just those insulins and GLP-1 agonists, and if you have vaccines in there alone. This is where the third basic inventory cost, known as carrying cost, comes into focus. So there's first the capital investment, or the inventory's actual purchase price, and that's the most easily identifiable, and then we have the carrying cost of what does it cost to hold this on the shelf until we have a sale. And so taking basic inventory costs minus and carrying costs will get you your true inventory costs. Secondly, we have inventory service costs, such as handling, insurance, and taxes sometimes are also another component. And thirdly, storage costs outside of the actual pharmacy contribute to the carrying costs of inventory. So, you may have to have an additional freezer for vaccines, or an additional refrigerator for vaccines. And then finally, those are those risk costs. And those risk costs are usually made of obsolete, where we have short-term dating on certain medications that can expire, damage, and obviously shrinkage and risk for theft. So a good inventory management is often a trade-off between the costs associated with keeping the inventory on hand, the carrying costs, and the benefits of having enough inventory in stock to be able to sell and then eventually convert to cash. The carrying costs of maintaining higher levels of inventory must be balanced with the less easily measurable costs of stockouts, loss of sales, poor patient care satisfaction, and even the business's or institution's reputation. That is why med synchronization in 2021 is still should be the cornerstone of all community pharmacies, in my opinion. Nice thing about long-term care pharmacy, closed door pharmacy, is they've been doing med sync since the beginning. But if you can sync people's meds, you can project when they're going to need those medications, and we can order them in a real time of when they're going to pick them up versus guessing when they're going to show up. And MedSync can be a great way to decrease your carrying costs, however, prevent less costs of stockouts. Pharmacists I know in the Seattle, Washington area did a study, oh, probably about 15 years ago, that looked at what it cost to fill O medications. All right, was about $8 per prescription when they took in getting the product in again, processing the label, counting the pills in a bottle, that there was an additional $8 in just O cost, let alone the potential of losing that customer because not able to have product in stock when they show up. Because most people, when they show up, they want to be able to get all their medications and not have to make a second trip. The other thing we have to consider is all medications, as we know, have expiration dates, after which the value is substantially reduced. All right. The other thing is that's why it's so important that we are simple things as rotating stock is essential. Regularly monitoring of expiration dates. Depending upon your wholesalers, wholesalers will allow you to return it to get full price as long as the product is intact and has not been damaged or opened within a 3 month to 6 month range. Many wholesalers will allow that, based upon the expiration dates, but you only get a certain percentage back. That's also too is if you are a chain that can share product and find out what stores uses versus the other. A couple years ago, when we switched our pharmacy systems to Pioneer, we also partnered with a company called Data Rhythm. And what Data Rhythm does for us is it looks at all our stores and it looks at what inventory has been dead weight for almost 90 days and then looks at what other store might be using that product so that we can transfer that out so that we can actually work down our own inventory before we purchase new inventory. And we have been able to get our inventory significantly reduced since we incorporated the system. The other thing you need to think about is damaged inventory is possible at any time. And so certain things is, sometimes expensive products you may not label until the patient shows up directly at the pharmacy. You may have it in a bag with the label. And that's because if something's labeled and you can't get the sticker off, it is usually not returnable to the wholesaler. So making sure we protect against damage, making sure we monitor our refrigerator temperatures, all those things can play a big role in terms of shrinkage cost. All right. And shrinkage is when the final calculated inventory value in the company's accounting records is compared to the final evaluation from the physical inventory, and any shortage referred to as shrink. Inventory shrink is expressed in the actual dollar amount difference or as a percentage of the total inventory balance. Usually, it might be theft is attributed to the existence of shrink, both by the customer shoplifting or, unfortunately, I hope you haven't had to experience this, but a lot of times managers do experience it at least once or twice in their lifetime, employee theft. Proper controls over access to inventory, good housekeeping by pharmacy managers can help minimize shrinkage to its lowest form. And as I said before, not having a medication in stock has a cost associated with it. Therefore, the prevention of stockouts is a goal of proper inventory management. Stockouts must be avoided by maintaining a safety stock or minimum amount to always be on hand. It's determined in relation to the expected usage as well as delivery lead times. And so you always have to look at, how quick can I have this order in? Do I only get a 5 days a week order? Do I get a 6 days a week order? And do I have enough to handle my inventory on the amount of times I can't get real time inventory? And although there are carrying costs associated with the safety stock, the potential costs of damaging customer relations and future businesses usually exceed them and justify having a cushion of safety stock. But as I said before, when we start talking about brand medications, when the margins are so thin, having too much stock versus converting and affecting your cash conversion cycle is a delicate balance. And so developing real reorder points is a must. And as I said before, med synchronization can also help prevent this. There are two types of inventory values and quantities. There's the perpetual and periodic method. And depending upon what your accounting company agrees to, that is what you should stick to. So basically, For perpetual inventory, it's the sum of all the SKUs will produce the final inventory amount. In theory, the actual inventory quantities on the pharmacy shelves should exactly agree with the value shown in the perpetual inventory record keeping system. One of the things we do now in our pharmacy, instead of doing a yearly inventory account, which we still do occasionally, is we do cycle inventory, whereas we will pick certain bays where we will count them per, one of those bays per week out of per month. And so we have certain staff assigned to do that cycle inventory. The second inventory record keeping method is the periodic inventory system, which is less often used because it provides fewer details. The inventory value is determined on a periodic basis. And that cycle inventory I told you kind of equates to perpetual inventory because we are still keeping it in real time. One of the things is all our pharmacy systems either have an icon counting machine or we have a script pro, and those both interface with our pharmacy inventory system. And so most of the time those are pretty much dead on because part of our workflow is one or the other has to be accounted for inventory, and even if it's a bulk product it also has to be scanned to determine inventory. But periodic inventory is determined on, as the word states, a periodic basis. Under that system, at the end of the various operation periods, the inventory count is updated to reflect the actual value of the inventory on the balance sheet, and this corresponding amount to be recorded as cost of goods sold. During the period, all inventory purchases are recorded only in the total amount of purchases. So you have a beginning inventory and an ending inventory. At the end of the operating period, the inventory value is determined by taking a physical inventory. The extension process begins whereby the actual quantity on hand is multiplied by the current cost, which yields an extended inventory. The extended inventory provides the final dollar value of the inventory and is shown on the balance sheet. And so this is just an example of doing a periodic inventory. So in summary, the periodic system equals simplicity, but its limitation is being able to provide cost of goods on a regular basis. Perpetual inventory is more real time and it has more detail, and you can do a better individual analysis. And this is what most pharmacies do today. The next part about inventory valuation methods. There are three inventory valuation methods. Under each inventory valuation method, assumptions must be made regarding the flow of inventory costs. Cost of goods are different under each inventory valuation method, which in turn will yield different ending inventory balances, gross profit, and net income amounts. And that is why, as an accountant um, company, you will determine which valuation method you're going to use for that year. Regardless of the method, should always be based upon the earliest expiration date of the individual inventory items. And regardless of the method, inventory purchases are recorded exactly in the same manner. So this is an example of, even sample of inventory purchases. So we have FIFO, which stands for first in, first out method. This reduces inventory value for dispensed inventory in the same order for which shipments are received. It is sometimes also referred to as last in. The advantage of a FIFO inventory valuation method is shown on the balance sheet, where the inventory value reflects the most recent purchase costs. FIFO, cost of goods, is based upon the cost of material bought earliest in the period, while the cost of inventory is based on the cost of inventory uh, based on material bought in the later period. During periods of inflation, the use of FIFO will result in the lower estimate of cost of goods and a higher net income. LIFO, which a lot of pharmacies use, is last in, first out inventory valuation method is the direct option of the FIFO inventory. The earliest inventory items purchased are the last inventory items sold. Therefore, LIFO may be referred to as first in, still here. Accordingly, since the last inventory items purchased are assumed to be the first inventory sold, there is a better matching on the income statement with cost of goods reflecting the current cost of inventory items. So FIFO method, the income statement reflects early inventory acquisition costs, which may or may not reflect current inventory replacement costs, and therefore our net income might seem higher. LIFO's importance of closer matching inventory costs on the income statement is critical in periods, especially of inflation and rising costs. LIFO will produce the highest estimate cost of goods and the lowest corresponding net income, and is probably more true to real evaluation. So there's those different inventory options that an accountant can use. As I said, LIFO will understate the inventory values on the balance sheet as compared to FIFO. LIFO has tax benefits during periods of high inflation. Switching to FIFO to LIFO in value inventory, there's likely to be a drop in net income and a current increase in cash flows due to tax savings. WAC, which is another option, is weighted inventory cost valuation, is a compromise between FIFO and LIFO. The WAC per unit is calculated by taking the cost of goods available for sale and dividing by the total number of units for that period. And at the end of each accounting period, this weighted average cost per unit inventory is determined and reflected both in the balance sheet and the income statement of cost of goods. WAC the levels out the effects of the market fluctuations in inventory pricing. It's best to use WAC in periods of fluctuating prices because the effects on both the balance sheet and the income statement can be minimized. But like I said, you can only change your inventory method per tax year. The selection of their inventory valuation is usually determined by upper management and the accounting department. Managing inventory turnover. Inventory, as I said, represents one of the largest uses of cash within the pharmacy next to pharmacist's salary. The most carefully controlled of all operating costs and expected function of all pharmacists are going to be involved in managing of inventory. We have the inventory turnover ratio. We talked about some of these in our financial ratio studies. Inventory turnover equals the cost of goods sold divided by the average inventory. The average inventory is the beginning inventory plus the ending inventory divided by 2. And this is just a sample of looking at inventory turnover ratios. And those turnover ratios can look at a way to evaluate the efficiency of that inventory. Some items may have higher turnover rates than the overall operation. Fast movers may be purchased in larger quantities, turnover more frequently, and can have a significant impact on profitability. And we can have separate turnover rates for other sales, such as over the counter. Whenever inventory ratio is lower than the benchmark, this can be an indicator that the inventory is too high. We talked about this in our financial examples. Possible reasons for this might include deterioration, damage, obsolescence, or overestimation need. Higher turnover ratios should result in increased profitability due to less cash tied up. Today, most pharmacy businesses try to work in just-in-time inventory. As I said, most of us can get inventory the very next day. And just-in-time inventory control is generally not sensitive to rapid changes in demand. So, for example, during allergy season or cold season, we may see a rapid increase in allergy, cough, and cold medications and antibiotics, and we may need to adjust our reorder points during these time periods. Ideal inventory level is needed to help in the pharmacy managers in making purchasing decisions. This is based on how much the product a business use, how fast they use the product, and the cost associated with ordering and carrying the product. And this is one of the most important things that all pharmacy managers should review their shelves at least once a week, if that. When a business places orders based on these variables, it can minimize total inventory costs. So using this information as a pharmacy manager, we can determine the most efficient quantity of product to order, known as the economic order quantity. The economic order quantity should be used as a tool to inform us for the just, in time inventory. And we can look at this taking 2 times our annual usage in units times the order cost divided by our annual carrying cost per unit, where the annual carrying cost per unit is the unit cost times the carrying cost percentage. This formula, all right, is a good way to look at it. Can help us in looking at our total inventory costs, which is our purchase costs plus our ordering costs plus our carrying costs. So example, a simple pharmacy has an annual requirement of 1,000 bottles of a product and the cost per order is $2. If the cost per unit is $10 and the carrying costs are 5%, we can then calculate, the estimated order quantity. And so by taking that, all right, we'll find that, yeah, the product itself costs $10,000, but there's about $56 in terms of the carrying costs. The total cost for the year would be 10,056, which means it would be cheaper for the pharmacy to order 89 units at a time as opposed to the other quantity, because all the other quantities will result in higher total costs, especially when we factor in the carrying costs. Once the EOQ is calculated, the number of orders per year is found by developing the annual utilization, which equals 11.2, approximately 11 orders per year. Along with knowing the optimal quantity of inventory to purchase, we also need to know when to place the order. And because we're doing just-in-time ordering, we need to develop reorder points. Calculating a reorder point also requires us to know the lead time from placing to receive an order. Thus, the RP is commuted as the following. It should be the lead time times the average usage per unit of time. So when can we expect that inventory? This tells us the inventory level at which a new order should be placed. If we need a safety stock to limit situations where there are stockouts, then we increase the reorder point by a few days to ensure consistency of supply. The nice thing is modern computer systems can take the knowledge of the estimated order quantity and the reorder points and look at the needs of that. That's one of the things that data rhythm software I talked about. It will adjust and modify that. And so, given the realities of modern day pharmacy operations, including lower profit margins, it should be clear that inventory management is crucial. Using this financial information, understanding inventory costs, reorder points is essential to control inventory. I didn't go into the whole details of calculating reorder points, but those are some things you would work at a higher manager level, and we can talk a little bit about this when we meet live. Okay. Thank you, Christina.